Have you ever peeked at a company's financial report and wondered, wait, how exactly are they valuing their investments in other companies? Because let me tell you, it's not always as straightforward as you might think. Today, we're going to dive into the rules that decide how one company's stake in another actually shows up on the books. So the entire way an investment gets accounted for, it all hinges on one single really powerful concept: influence. Yep, that's it. How much say does the investing company actually have over the company it just bought into? That one factor, right there, determines everything that follows.
And this brings us to what we can call the ownership spectrum. Just think of it like a sliding scale. The more of a company you own, the more influence everyone assumes you have. And that's what dictates the specific accounting method you absolutely have to use. Okay, before we go any further, let's just nail down a key term: an equity security. That's just the official fancy name for an ownership stake in a company. So we're talking about common stock, preferred stock, or even things like warrants and options to buy stock down the road. It's your piece of the pie.
This chart pretty much maps out the entire journey for us. See, it starts down at the bottom, with low ownership and very little influence. But as that ownership stake crosses the 20% threshold, you gain what's called significant influence. And if you go above 50%, well, that becomes control. Each of these levels comes with a completely different accounting rulebook. So for this explainer, we're going to zoom in on those first two major categories on that spectrum. We're going to compare what happens when a company is just a passive investor with little to no say versus what happens when it owns a big enough chunk to have a real voice in the room. Let's start at the bottom of that ownership ladder. When you own just a small stake and you have little to no influence, you're going to use what's called the fair value method. The rules here are really direct, and they're all tied to the market. First, the investment is always listed at its current market price. Second, any little wobble in that price, up or down, gets reported as a gain or a loss on the company's income statement. And get this, that's even if they haven't sold the stock. And finally, any dividends you get, that's just treated as good old-fashioned income. Theory is one thing, right? But let's see how this actually plays out. So imagine a company, we'll call them Abico, buys a very, very small stake, less than 1%, in another company, Galeco. So on November 1st, Abico makes the purchase for $20,000. On their books, cash goes down, and an investment asset for $20,000 appears. Pretty straightforward. But by the end of the year, Galeco's stock price has dropped to $90 a share. Whoops, Abico's investment is now only worth $18,000. Now, that $2,000 drop isn't just a quiet note in a file. It gets reported as a loss on Abby's income statement for the year. It literally impacts their reported profitability. And this just perfectly illustrates the flip side. The next year, the market recovers and the stock price jumps all the way up to $115. The investment value shoots up to $23,000. That $5,000 increase from the last report is now recognized as an unrealized gain, boosting Abico's income for that year. You can totally see how volatile this method can be. Okay, but what happens when you have more skin in the game? Once your ownership gives you significant influence, the rules change completely. You switch what's known as the equity method. So what exactly is significant influence? Well, while it can be a bit subjective, the general guideline is owning between 20 and 50% of a company's voting stock. At this level, you're no longer just along for the ride. You're presumed to have some real say in that company's financial and operating policies. The equity method operates on a totally different logic. It's way less about the daily stock price and much more about the performance of the actual business. You start with your initial cost, then you add your percentage share of the company's net income, and finally, you subtract any dividends you receive. And this is the most critical difference you have to understand. Under the equity method, when you get a dividend, it is not counted as income. Instead, it's treated as if the company is just giving you back a little piece of your original investment. So it actually reduces the value of your investment on your balance sheet. So we've got these two completely different ways of looking at an investment. Let's put them side by side to really drive home how different they are. I mean, the differences are just stark. Look at the balance sheet value. Fair value bounces around with the market price, while the equity method follows the business's actual performance. Dividends? One treats it as income, the other as a return of your capital. But the biggest difference is right here. With the equity method, the other company's profit becomes your profit. That just does not happen under the fair value method.
You know, this quote from the source material just perfectly captures the spirit of the equity method.
It's saying you are so intertwined with the other company that their financial success or failure flows directly through to your own income statement.
So here's the bottom line. Each method tells a very different story. The fair value method tells a story about market sentiment, about stock charts, about volatility. The equity method, on the other hand, tells a story about partnership, where your financial results are directly linked to the operational success of the company you've actually invested in.
Which leaves us with a really important question, doesn't it? If the accounting rules can paint such different pictures of the very same investment, it kind of forces us to look beyond the surface. It shows that understanding why a number is what it is can be far more insightful than the number itself.